Hi everyone, welcome again to another financial analysis video with myself, Moeed Amin, and Ted Wayman. So today we're going to be talking about a well-known British institutional brand, and that is Royal Mail. So any of you who are not in the UK, maybe unfamiliar, Royal Mail is essentially a postal and courier service business. It was founded in 1516 or established in 1516. It was established, get this, by King Henry VIII. I didn't know that. Ted, did you know that?
No, I didn't know that at all, Moeed.
Yeah, I thought that was an interesting piece of news. Didn't realize he had the time with all those wives, but I thought that was quite interesting. And it was established as a governmental department, which then spun out as its own corporation. Now, this company's an international business, although it's established in the UK, well known in the UK. It actually has an international reach, and it works through brands like Parcelforce International, which is the courier service. There's General Logistics Services, which is its arm in Europe. And actually, it acquired a road freight business in Canada called Rosno, I think it's called Rosno Transport, for 210 million. So it's obviously got ambitions to expand even further than Europe. It also operates with a brand called Parcel Express in the USA. And it also has a company called Market Reach. Now, essentially, Market Reach it's a part of business that helps marketing in businesses, agencies, marketing brands and agencies in terms of using mail as part of its marketing strategy. But it also provides market research into the mailing industry and the potential there. So I thought that was quite interesting. It provides those kind of professional services. Has about 158,000 employees, so very large business, very large employer in the UK. And what was interesting that I saw was they're obviously investing in the future, and we're going to see some of that in the P&L. But they're investing in things like electric transportation, etc. They're also investing in being able to increase the level of automation in its parcel sorting system. And they have ambitions to reach a level of 90% of their parcel sorting to be conducted by these automation systems. And it's important to know that because currently it's around 50%. So all of this kind of information is going to be interesting in terms of context. We're not going to dive into that in too much detail, but just wanted to share that with you in terms of context. Now, this company that we're analyzing today came from a couple of requests from our viewers. So clearly a kind of one that's interesting to everyone. So RS Forthwin and Mohammed Awais, thank you very much for your request. Here is your video. And don't forget, viewers, to like, share, subscribe. If you are a subscriber and you make a request to us, as these two individuals have, you will get an instant notification of when your video has been analyzed and published. So don't forget to hit that subscribe button and hit that notification button so that you get the request, so that you get the notification, of course. We're going to go into the share price, and very interesting information around the share price in terms of the analytics on the P ratio, dividends, etc. So stick around for that, because that was very interesting to look at. Just to give you an idea of the share price, floated in 2013, and if you'd invested then, you'd be sitting on a decline of 43%. 5 years ago, a decline of about 36%, and a year ago, a decline of 55%. So could this make it an opportunity for a buy? Let's have a look. And we're not here to give you financial advice. These are just our opinions. But the purpose of this show is to help you raise your financial acumen and financial knowledge so that you can analyze these future statements, particularly their quarterly statements, in a much easier and quicker way. So, Ted, let's share with our viewers what we have uncovered about this well-known UK brand and some interesting financials there.
Yeah, thank you very much. Good to see you, Moeed. I hope you are well, and welcome to all of our viewers. So Royal Mail, big fan of Royal Mail. My local postman is called Richard, and he dresses as a superhero every single day. So he is definitely our superhero. And so if anybody else out there has their mail delivered by Batman one day, Captain America the next day, and then Superman the next day, then you probably live just around the corner from me. So he's now Royal Mail, don't confuse him with the post office, very, very separate to the post office. And Royal Mail, as Moeed mentioned, going all the way back to King Henry the VIII, the Royal Mail invented the stamp. So before that, it was very much the person who was receiving the post paid for the privilege of receiving it, and the stamp allowed them to start to charge the person who was sending that, back in the old penny black days, Queen Victoria. So without further ado, on our history lessons, we're here for a financial lesson rather than a history lesson. So here is the Royal Mail PLC. Here is their annual report and account. It's available on their website. You can look at what they do in detail, where they're going, why they're doing it, what their strategy is, all this kind of investment, as Moeed mentioned, in technology, which is a big driver for the business. But we are going to whiz down and look at the financial statements. So here are the financial statements, and we're going to start off with the income statement. So we are now looking at the income statement. Here it is, sorry. So we are dealing in millions of pounds. So there we go, it's millions of pounds for the 52 weeks ending in fact, 2022. So this is the end of March 2022. We're now in June, end of June 2022. So these are reasonably recent figures. So the revenue, now interesting enough, so the revenue, so 12.7 billion pounds, 12.7 billion pounds, a little bit up 1% on the previous year. Now, do remember the previous year, this is pandemic year. So pandemic year, and suddenly we're all staying at home, and the only way that we can kind of, send, we can't take something around, we have to send it. And so people like the Royal Mail will have seen a big increase in their revenues. And what this tells me is that the Royal Mail has maintained that. So they've been, they've captured market share, they've seen an increase in business, and they've managed to maintain it. One might expect it as we get out that we no longer need the Royal Mail so much, and therefore that revenue would have dropped. And then you notice the next line are their operating costs, very high. So if we take the kind of the operating profit here, it's only about 5%. So this is really, really tight margin. And as Moeed was mentioning, these people costs, increased automation should reduce those people costs. And you've got then distribution, conveyance, infrastructure, et cetera, et cetera. But that's the kind of, I guess that's the kind of the Achilles heel, those people costs, especially if you're thinking about the future, inflation, and they want to start asking for pay rises. And if it's going to be a 10% pay rise because it's going to keep up with inflation, that's going to, that's going to wipe out that operating profit. And so there's not a lot of room for error on these guys. So if they can move towards that automation, if they can keep those wage rises and those wage demands under control, then that's looking good. But if they start to go on strike, then the revenue is going to come down, and it could really, really hit the bottom line pretty hard. So that's a really kind of to be aware of. So not a big margin business by any means. Little bit of interest they're paying, which means they'll have a little bit of debt. They're paying a little bit of tax. Bottom line, 6 million profit on a 12.7 billion turnover, about 5%. Okay, so tight margin business, not a lot of room for error. And the Royal Mail, I mean, it's good value. I mean, I do use them, and generally speaking, it's it's as cheap or cheaper than a lot of the alternatives. So they are competitive. They're pushing towards that automation, as you mentioned, Moeed. But there is that Achilles heel that they are very, very unionized. Those 158,000 employees you mentioned, if they all strike and start demanding increased wages, then these guys could go south very, very quickly. There's the income statement. Let's go look at the balance sheet. So here is the balance sheet, and the top half of the balance sheet shows the non-current assets, the things we need to run the business. Big number up here is their property, plant, and equipment, and that's only going to get bigger as they continue to invest in all of that automated equipment. What's also interesting is this number here. Now, I'm not an expert on pensions, but they have a retirement surplus on their pension. Now, that's good. These guys, they only floated. They were sold by the government a few years ago. In fact, I was a buyer at the time and sold pretty quickly as the price went up. But these guys, they've got this surplus a retirement benefit, and I think that is that's obviously a good thing when lots of companies quite often have deficits. The other thing to mention is that there is some speculation that this number is undervalued. So these guys, there's a lot of property in there. There's a lot of freehold property, and there's sort of theory that it's held at book value rather than at market value. And actually, some of their property really is, it's in prime real estate in London. It could actually be worth quite a lot more than they're showing on their balance sheet. So potentially the book value of this company is being understated. Current assets, things we're trying, either cash or going to become cash soon. Here they are. What do we see? Well, they're owed a bit of money. There's no real inventory, and they've got a lot of cash. They've got over $1 billion in cash. They had over $1 billion in cash in the previous year. So these guys looking pretty liquid to me. Decent cash holdings, which is good. On the current liabilities, total current liabilities 2.7 billion. Compare that with 3 billion of current assets. So from a liquidity ratio, not looking too bad. And most of those current liabilities are trade and other payables. So basically they're suppliers. So that's looking pretty good. No real warning signs there. And then a little bit further down, we get their kind of the non-current liabilities. There's a bit of a deficit on the other side of that pension scheme, but that's, very, very small compared with the surplus. They've got a little bit of loans. That's fine. But most of it is lease liabilities, and that's just a sort of new accounting process of bringing those operating leases onto the balance sheet. So nothing really kind of bouncing, just shrieking out at me, and therefore, the net assets 5.3 billion. There they are again, 5.3 billion. The balance sheet balances, a little bit of investment, and these guys really, it's all funded through retained earnings. So they're profitable. They've been making profits. And those profits have been reinvested back into the business. 4.8 billion to 5.3, 5.2 billion. Those profits are being reinvested, and that's how the company's been funded. Quick check on the movement in equity. Here it is. So we'll see. We're looking at this column here, the kind of the retained earnings column. They made a profit for the year. That's the previous year, but they made this kind of what we call a comprehensive loss, causing the retained profits to go down a little bit. And then in this year, they made another profit. There's the 612 million of profit, a little bit of other comprehensive income. And look at this, quite nice. There's some share buybacks and some dividends. So these guys are paying dividends, and they are paying out, they're buying back their own shares. So, again, returning money to the investors. And, I'm hoping that is a kind of the start of, a kind of a standard policy where we will now be paying dividends out to shareholders. So that would make it a good investment. So last one to look at, cash flows. So here is their cash flow. And we see the net cash flow from operating activities. They're very cash generative. So lots and lots of cash coming in. A lot of that cash is really driven by the fact that they are profitable. So there's the profit figure, and then there is the depreciation amortization. So basically, you'll notice there's the EBITDA, which is earnings before interest, tax, depreciation, and amortization. And that EBITDA is very much reflective of the cash profit, as we would expect. So EBITDA often treated as a kind of, as an approximation, as a back of an envelope calculation to work out the cash profit. So very, very cash generative, which is good. Here is the money spent in financing. So buying property, plant and equipment. So this is the automation you're mentioning. Buying other businesses as well. So they are expanding, as you mentioned, Moeed, expanding overseas. So big investment going on from these guys. But if they are generating if they're generating 1.1 billion and they're spending 760 million, then the difference is they've still got 401, and that's a sort of a form or one method of calculating free cash flow. And then they got the financing activities a little bit further down. So, there's the share buyback. There are the dividends that they're paying out. And then they're paying back on some of those leases as well. You'll notice the previous year, big buyback, big repayment of loans. So they've really kind of brought the debt on the balance sheet down significantly, and now they're feeling that comfortable, they've got their balance sheet under control, they can start to distribute profits to the shareholders in the form of share buybacks and dividends. So all looking pretty good. Let's go and have a look at their share price and see what this is telling us. So here is the share price. So since if you invested since they floated, and there is them floating, then you're in the red. I mean, they have gone down. They have been bouncing around. Here's the pandemic, so kind of everything going up, especially these kind of guys. But since kind of the unlocking, they've been on a steady decline. Now, what are the numbers telling us? So first of all, if you remember, Moeed, first of all, we've got a market cap of 2.6 billion. Okay, that means that their price to earnings ratio is about 4.4 times. I'll read that again: 4.4 times earnings. If you buy this company, you will get your money back in 4 years. Okay, that's slightly crazy. It's a 25% yield. It's the equivalent of investing in something that yields 25%. With the dividends, you're getting, well, they put a 6% yield, but by my calculation, the dividend of 366 million on a 2.6 billion market cap is a dividend yield of 14%. So I'm not sure where that 6% comes from. And if you include the share buybacks as well, that's a yield of 22%. So very, very big yields, very low P ratio. This tells me the company is very, very cheap. The net asset value, the net asset value of the balance sheet, 5.3 billion, and they're trading at 2.6 billion. Okay, that's basically, if you buy the company for 2.6 billion and then just close it down, you're going to get 5.3 billion in return. So they are trading at below book value. Again, another sign of potential, a very, very cheap stock. And don't forget, I did mention that comment about the property, that if the property really is undervalued, then potentially that balance sheet could be worth even more. So this really looks like a bargain for someone. And you mentioned that perhaps there were kind of other companies out there, maybe even the PE companies, looking at these guys and thinking, do I want to buy them? So this looks a really, really cheap stock. Now don't forget, again, there's always that Achilles heel. There's always that kind of that potential for really kind of messing up with the workforce and the strike action, and and that will kill their margins. So you need to be careful that there is a high risk, especially in this inflationary environment that we live in, that these could all go south. But this looks to me, Moeed, like a company which is definitely a potential, just to kind of tuck it in the corner of your portfolio and ride out the waves. I can't see it getting that much cheaper. If they strike, then things will go. But if you avoid the strike, then this looks to me like a value play for the future.
Yeah, and just a note hot off the press, and I think this happened only just a day ago from at the time of this recording, there was an approval of a strike action. However, it was only 500. Oh, sorry, no, I can't remember how many of their staff, but basically they proposed cutting about 542 of their frontline management staff, delivery manager staff. And it was all about redistribution, and they were unhappy with that. So they decided to strike. So there is a real example there of the risk that Ted has just talked about, which is the strike actions happening, and particularly in a high inflation wage spiral environment. Could those wages requests go up, and what would that mean to their profitability? So definitely worth considering that and doing your own research about something like this, because their union is pretty strong in the UK. So that was a really, really interesting company to analyze. And thank you to our 2 viewers for requesting that. We'd love to hear everyone else's thoughts, right? So if you are someone who knows this industry really well, or knows about the technologies being supplied to an industry like this, we'd love to hear from you. Do leave a note in the comment section. And if you're watching this video and thinking, you know what, I'm really interested in these companies, I would love for these guys to analyze those companies, do leave a note in the comment section, leave some context. The more interesting the context, the higher likelihood that we will prioritize your request. So do leave a note in the comment section. So until the next video, thank you, Ted. Thank you, everyone else. We'll see you soon.
Thanks a lot, Moeed. Catch you later. So I hope you enjoyed that video and found it useful and informative. Now, if you want to know more about what I do, then you can visit Talk Financials and find out about the training workshops and the clients that I work with. And the QR code is on your screen right now. If you are interested in being able to do this yourself, to do some financial analysis, there's a couple of resources. There is an online workshop. It's available on my website, or you can click on the QR code and it'll take you straight through to this online workshop where you can learn to read and understand and interpret financial information yourself. Alternatively, there is a book available at all good bookstops, particularly a very big online one, and the QR code once again will take you through to the opportunity to buy the book, and there is also a Kindle edition. Otherwise, that's everything from me. Please, please, please don't forget to like, share and subscribe to the channel. More subscribers means that you're going to get notification about new videos coming up, and also the opportunity to ask questions, and do recommend any videos any companies that you'd like me to analyze for you. I think we've got a couple of suggested next videos coming up, so please do take the opportunity, have a look at the other videos, and don't forget to like, share and subscribe to the channel, and I will see you on the next video.